this slide, I think, could happen quite quickly. I mean, once the credit bubble bursts, I've got people who sort of, seem to have been very successful in terms of, reading cycles and things like that. And I think we're looking at March next year, ultimately. But I wouldn't be surprised if it happens before then. The only way you can get out of this, basically, is get the hell out of credit. It's really dangerous now. Get out of credit, which means getting into real money, which is metallic money with no counterparty, and it is final settlement for all credit, and that is gold.
Across global markets, a growing sense of unease is turning into something far more tangible. Stock valuations, which have been levitated by over a decade of unprecedented monetary expansion, now appear dangerously stretched. Cryptocurrencies, once hailed as the new hedge against inflation, have begun to mirror the erratic cycles of speculative tech equities, falling in lockstep with broader risk assets. Meanwhile, the traditional safe havens, gold and silver, are quietly asserting themselves once again, climbing against a backdrop of deepening credit strain and accelerating currency debasement. This is the scenario that seasoned economist Alasdair Macleod has been warning about: a global financial order approaching its breaking point, where the collapse of the fiat system could unfold far more quickly than most investors anticipate. Macleod's warning centers on what he describes as an inevitable implosion of the credit bubble. Every fiat monetary system, he argues, ends the same way, crushed by the weight of unpayable debt. The U.S. Treasury's growing reliance on short-term T-bills, in lieu of longer-dated securities, signals a structural liquidity crisis hiding in plain sight. The cycle of quantitative tightening, followed by forced liquidity injections, mirrors the behavior of late-stage credit systems desperately trying to stave off collapse. This pattern, seen before in the early 1920s Weimar Republic and during the 1929 U.S. crash, suggests that today's financial architecture may already be entering its terminal phase. The urgency of Macleod's call cannot be overstated. As liquidity vanishes, leverage unwinds, and the world's largest economies spiral into competitive devaluations, investors who remain trapped in paper promises risk seeing their wealth evaporate in real terms. The time to prepare is now, before the panic becomes obvious. Gold and silver, the only forms of money without counterparty risk, are no longer merely hedges. They are the escape hatch from a monetary system built entirely on debt and faith. In this video, Alasdair Macleod outlines how the global credit system has reached an irreversible tipping point and why investors must take action immediately. Stay with us as we unpack his detailed forecast and explore the implications for investors preparing for the end of the fiat era. If you like deep dives like this, don't forget to like this video, share it with other investors, and subscribe for more videos. We appreciate the support and hope you enjoy the video.
Looking at the DXY breaking 100, it's a race to the bottom.
Mm-hmm.
I mean, basically, what of the major currencies, constituents of the DXY, would you buy or sell? It's immaterial. Really, what's happening is that the whole of the fiat currency system is coming to an end. And we're seeing evidence of this. Every fiat currency system comes to an end because of the accumulation of debt. And that's basically what we have at the moment, Danny. It's got to the point where it's not sustainable. If you look at what the US Treasury is doing, it's funding itself out of T-bills. It really is. The problem is there's no market on the long end of the yield curve. So they can't actually go out and replace maturing long-dated stock with more long-dated stock. In other words, ensuring that the annual rollover, if you like, of debt is contained. No, they're replacing long-dated with T-bills. I mean, that's where the market is. But what it does mean is, in effect, the US Treasury is printing money. I know it's using Fed dollars for it, but it's printing money because T-bills are near cash. If the other side of the balance sheet is near cash, then you can see what's happening. It's leading to a certain amount of liquidity problems, because if the government, if the Treasury doesn't spend this money, and at the moment, major parts of the government are suspended, then it accumulates in the general account. So it goes out of circulation. So it doesn't go back into bank balance sheets, if you like.
Mm-hmm.
So on that basis, you can see that, this is tightening the system. On top of that, we had QT, which was also tightening the system. And this is why the Fed has stopped doing QT and will reintroduce from this month, next month, whenever, quantitative easing. But that, again, is printing money. So, we're on a printing credit roundabout now. How else can we print it? Well, let's find another way of doing it. That's where they are. And this is roughly where Germany was, I think, in the very early 20s, 21, early 22. And we know what then happened. And we can see how it's going to happen here too, because when the credit bubble bursts, and the credit bubble will burst, this is the biggest credit bubble in history. And on top of that, it's looking so much like 1929 with Trump's tariffs on top, replicating Smoot-Hawley and all the rest of it. When it bursts, what it's going to mean is that the Fed and the Treasury will stand by to rescue the entire banking system and also all the major zombie corporations in the US economy. They have to do it because of the unemployment mandate, if you like. And of course, the Fed is also seeing in its beige book signs that the economy is falling over, toppling, if you like, stagnating, however you like to put it, turning down. So this is a time of maximum risk. Now, at the moment, I don't think that the stock market really realizes this, but there will come a point when it does. But for now, I think with extra QE coming in, if you like, the tightness in credit markets being alleviated, it could well feed into yet higher equities in the very short term. Because, what this credit has been doing is it's just been puffing up equity markets. It's been angled at financial markets. Just look at the level of margin debt. I mean, the level of margin debt is over 1.1 trillion, having risen over the last 10 years from about 300 billion. And that is financing stock positions. We can guess roughly 3 times that. So when this bubble pops, the banks will be foreclosing as quickly as they can, which of course will drive the market down even more rapidly. And the interesting thing is watching Bitcoin, because Bitcoin basically is a tech stock with no assets, no earnings, but just the vibes, if you like. And you can see that it correlates so closely with the Magnificent Seven. Magnificent Seven go up, it goes up. Magnificent Seven goes down, it goes down. So what's it doing now? I mean, Bitcoin basically is threatening to break out on the downside. It's dipped below its 250-day moving average, and I suspect that if it breaks that $100,000 level, you will see an avalanche of selling. There are an awful lot of people long of Bitcoin who are just in there for profits. I mean, we get from the sailors of this world this sort of wonderful stuff about how it's going to go to the moon and so on and so forth. But, people are in it not because they think it's the new gold. I mean, that's for the fairies. They're in it basically because they want to make money, and they think it's an easy way of making money. You get this at the top of every credit bubble. And what the whole of the crypto market is telling us is just that. We are at the top of the bubble. And there's an awful lot of leverage in it too. And that, incidentally, is not in the FINRA's statistics. I don't know how much leverage there is, but this is a global problem. Things are going to turn sour. Now, it's always impossible to pick the exact top in a credit bubble, and you can be wrong for 10, 15, 20% easily, even though you've analyzed it correctly. So I think I'm not prepared to say that we are actually at the top and all the rest of it, but I'm seeing a few things breaking down. And we know we've got the liquidity crunch, and we know that what the Fed is in effect doing is moving from targeting inflation to supporting the economy and ensuring that it's got enough liquidity. That is bound to undermine the purchasing power of the dollar. So, okay, it's 100, but also at the same time, I mean, this is the king rat of currencies. Other currencies are in exactly the same boat. It's just a question of who goes down fastest. And at the moment, it's not quite the dollar. the dollar might win that race to the bottom shortly afterwards. I don't know.
As Macleod explains, the deterioration of the fiat system has reached the stage where even the world's reserve currency is losing credibility. The US dollar, once viewed as the ultimate safe haven, is now trapped in a race to the bottom alongside the euro, yen, and pound. The Treasury's decision to rely increasingly on short-term financing instruments effectively transforms debt into near money, expanding the money supply under a different name. This circular financing arrangement, where government liabilities are monetized through short-term issuance, mimics the dynamics of money printing, even if it is not called that outright. The consequences are already visible: tightening credit markets, suppressed long-term demand, and a fragile yield curve distorted by intervention rather than organic demand. Macleod suggests that this financial engineering cannot continue indefinitely. The last time Western governments found themselves in similar conditions, high leverage, monetary inflation, and speculative excess, was before the 1929 crash. This time, the scale is global, the debt load is immeasurably larger, and the interconnectedness of financial markets makes contagion instantaneous. While short-term liquidity injections may temporarily lift equities, they also amplify the underlying instability. The moment that confidence in fiat credit collapses, both the stock market and speculative assets like Bitcoin will deflate violently, leaving only tangible stores of value standing.
But the thing that's interesting is that these, with the system under strain, I guess this is why people like Jamie Dimon are saying gold's going higher, and why Morgan Stanley sort of turn around and say you should put 20% of your portfolio into gold. Now that's an extreme statement, a very extreme statement. But I think that the really senior bankers see these dangers. They must be concerned about it, and I think that they would have told the Fed, look, you can't go on tightening like this. We're losing deposits which are going into the general account, and we're not seeing it come out the other side. We are under strain. You carry on this way, you're going to see the same sort of thing we had in September 2019. You may remember when the repo rate suddenly shot up to about 9%, and the Fed had to come in and sort it out. But we're not far from that sort of thing happening. I mean, it is tight, very, very tight. But where does this take us? Well, the thing that's absolutely clear is that if we can look through the top of the credit bubble, when it starts going down, Danny, you will see inevitably the duty, if you like, of the Fed and the US government basically is to keep the show on the road. And how did they do it? They would just accelerate the printing presses. What did they do in Germany in 1922? Accelerated the printing presses. We have exactly the same situation. And on top of that, we can superimpose our lessons from 1929 to 1932. The difference is that in those days, businesses went bust because the dollar was on a gold standard. And the only way in which credit got wiped out was by debtors going bankrupt. And the debtors included something like 10,000 banks. They went bust and didn't honor their deposits. Today, of course, you don't have that. So where is the strain? What happens? How do you reduce the amount of outstanding credit? Well, you don't reduce the amount of outstanding credit, but what you do is you reduce its value. Its value contracts, collapses even. And that's the way in which this is going to work. And the value of credit collapsing starts with the currencies. Currencies will go down. And unless the political class actually wake up to this, and unless their advisors get off all this macroeconomic rubbish and actually begin to apply proper classical economic lessons and inform the politicians of that reality, then there is no way that the fall in the purchasing power of these currencies is going to stop. That's what's required. We've got to go back onto a gold standard. In effect, do you see that? No, I don't see that. And I certainly don't think that 8,130 tons allegedly in the coffers of the US Treasury are there. I don't think they're there. I think there's a big shortfall. So you've got a credibility problem, which is being well aired, and it's well aired even by people like Scott Bessent. Guess what? As soon as he becomes Treasury Secretary and he gets his feet under the desk in the Treasury Department, what happens? He is told, don't say anything about gold. Stumm. Don't talk about it. Why? Well, I can see two reasons why. Firstly, they are in denial about gold because they have been promoting the dollar as gold's substitute, if you like. It's a dollar standard around the world. And the second thing is a lot of that gold, I think, went out. It was leased and never came back. You open Fort Knox, I think someone rather cleverly said, you find a whole bunch of IOUs sitting there. We don't know whether this is really true because, of course, we can only surmise. But intellectually and practically, I think it's going to be extremely difficult for the mighty dollar to if you like, get away from its total collapse. So that's what we face. I mean, this is a very serious time. We are in a sort of, if you like, in an intermediate stage where, the Fed is trying to put some liquidity back into the system because it sees the danger. It's been told the danger by its intelligence in the commercial banking network. That will give us a little bit of relief. It might even puff equities even higher. I don't know. But the only way you can get out of this, basically, is get the hell out of credit. It's really dangerous now. Get out of credit, which means getting into real money, which is metallic money with no counterparty, and it is final settlement for all credit, and that is gold. Well, it's impossible to say how long the final collapse of the dollar will happen, and you never know. I may be wrong. You could find that the authorities turn around and actually do something sensible, like secure the value of the dollar somehow. I mean, there may be some sort of fiddle they can do and all the rest of it. I mean, people have been talking about a reset for ages. It's not a reset. It's just to try and secure the value of the dollar. The only way that can be done ultimately is basically by going on to a gold standard. This slide, I think, could happen quite quickly. I mean, once the credit bubble bursts, I've got people who sort of, seem to have been very successful in terms of, reading cycles and things like that. And I think we're looking at March next year, ultimately. But I wouldn't be surprised if it happens before then. When that happens, basically, you should already be completely out of credit, because the collapse, I think, will be really quite rapid from that point. And they will obviously try and do what they can to stop it and all the rest of it, but it's just going to undermine the purchasing power of the dollar. So in terms of time, I don't think we're far away from the end of the fiat currency system. And the point about being close to the end of the fiat currency system is that we're close to it, fiat currencies not being there. Now, either they're replaced by something else like a new gold-backed currency or whatever, or they tie it to gold. And incidentally, have to take the economic actions to ensure that it sticks. We're nowhere near that. I don't know. I just sort of feel that we are actually moving more rapidly than we think towards the end game of fiat currencies.
When the credit bubble finally bursts, the global financial system will face an unavoidable reckoning. Macleod believes the collapse will unfold in two stages. First, through an implosion in credit markets, followed by the rapid debasement of fiat currencies as governments attempt to print their way out. Historical precedent offers a grim picture, from Weimar Germany's hyperinflation to America's Depression-era collapse. Yet unlike those periods, today's policymakers have eliminated the natural cleansing mechanism of bankruptcy under a gold standard. Instead of defaults extinguishing bad credit, modern systems allow credit to persist while eroding its real value through inflation. The result is a slow-motion destruction of purchasing power, culminating in an eventual loss of faith in money itself. This, Macleod warns, is where we are headed unless the world returns to sound money principles. But the likelihood of political leaders voluntarily restoring a gold standard remains slim. Many central banks no longer possess the physical reserves their balance sheets claim. The United States, for instance, officially holds over 8,000 tons of gold, but credible analysts, including Macleod, suspect that much of it has been leased or encumbered. The opacity surrounding Fort Knox and the absence of independent audits have only deepened these doubts. Once confidence in those reserves falters, the credibility of the dollar itself will collapse, triggering a global repricing of all fiat assets relative to gold. For investors, the implications are stark. The end of the fiat cycle will not be a gradual process. it will be an event. In such a moment, liquidity evaporates, institutions scramble for safety, and only those holding real assets retain control of their purchasing power. Precious metals, particularly gold and silver, stand alone as instruments of final settlement, free of counterparty exposure and independent of the banking system's solvency. In recent months, their steady ascent amid extreme volatility in equities and crypto is a clear indication that smart money is already repositioning. As the months ahead unfold, investors should expect greater turbulence, alternating phases of euphoria and despair in paper markets as central banks oscillate between tightening and stimulus. But beneath this volatility, the trajectory is fixed. The purchasing power of fiat currencies will continue to erode, while tangible monetary assets appreciate in real terms. Whether the full collapse occurs by March 2026 or sooner, the message is unmistakable. Time is running out for the current system. The prudent move is not speculation, but preservation. Reduce exposure to credit and paper instruments, and prioritize wealth that exists outside the financial system. The historical record is unequivocal. When fiat fails, gold prevails. If you found this analysis insightful, don't forget to like this video, share it with other investors, and subscribe for more deep dive discussions on global finance and precious metals. As the system edges closer to its breaking point, informed decisions will define who survives and who loses everything in the next great reset. Thanks for watching, and see you in the next one.